China didn't just reveal a silver gap. They revealed a 19-year blind spot so massive, so dangerous, so mathematically impossible to unwind that $83 billion is now hanging by a thread tonight. And the terrifying part? This gap didn't appear suddenly. It didn't happen last week. It didn't even start during the pandemic. It began 19 years ago, buried under trade flows, commodity swaps, and inventory reports nobody ever verified. A gap so large that if you'd noticed it sooner, you'd have understood exactly why China has been quietly moving in silence for nearly 2 decades. And now that it's exposed, markets have no idea what's about to hit them. Let me show you why this single revelation is more dangerous than every silver shortage rumor combined, why it's more devastating than any supply chain freeze, and why the $83 billion sitting on the line tonight could evaporate before the markets even open. Here's the part nobody's willing to say out loud. China didn't discover this gap by accident. They revealed it, deliberately, at a moment of maximum leverage, because this isn't a gap in data. This is a gap in control, a gap in who owns the global silver pipeline, who controls it, and who secretly relies on it without understanding what's really happening behind the curtain. For 19 years, China has been importing far less silver than their own industrial demand required. On paper, the numbers don't make sense, they don't add up, they violate basic arithmetic. Their photovoltaic industry alone, just solar, should have consumed twice the amount they publicly reported. Their electronics manufacturing, EV factories, medical equipment, 5G components, semiconductors, all require massive silver flows. Yet their import figures stayed suspiciously flat, almost artificially flat. Western analysts assumed China was recycling at impossible levels. They assumed China had mysterious secondary supplies. They assumed China must be sourcing silver domestically at volumes that don't exist. They assumed everything except the truth. And the truth is this: China has been quietly siphoning silver from global shadow channels, untracked, unregulated off-market flows, draining reserves from countries that didn't even know their inventories were declining. This is the 19-year silver gap, a global misallocation so large that the moment China revealed it, $83 billion in derivative exposure immediately became unsustainable. Because here's what happens next. When a gap like this is revealed, the market must reprice everything. Not tomorrow, not next month. Instantly. Silver prices aren't based on supply and demand. They're based on perceived supply and perceived demand. And now, for the first time in 19 years, the illusion is gone. The numbers are broken. The system is exposed. And China chose this exact moment to reveal the gap for a reason. This wasn't a leak. This wasn't a data correction. This was a message. The message is simple. They control the flow. They control the pipeline. They control the industrial choke points. And the West was asleep the entire time. When China dropped the updated figures, traders initially froze. Then they panicked. Derivative desks saw the exposure instantly. If actual global supply has been miscounted for 19 years, then every futures contract, every mining forecast, every ETF inventory chart, every warehouse number is now unreliable. Meaning $83 in leveraged silver positions, hedges, swaps, shorts, long-dated contracts are suddenly based on fake math, and that means liquidation. But it's worse, because the real question is not how big the silver gap is. The real question is, where did the missing silver come from? And that's where things get terrifying. Sources inside the metals. Logistics networks are saying something unprecedented. China has been drawing from sovereign reserves, quietly, through intermediaries, through offshore procurement networks disguised as industrial shipments. Silver, that Western governments assumed was sitting untouched in vaults, is gone. Not stolen, not seized, just rerouted. Slowly, quietly, invisibly. 19 years of small drainage that added up to a supply hole the size of an economic black hole. And now that the hole is exposed, everyone is scrambling to calculate how much remains. Some analysts say 300 million ounces. Others say less than 100 million. Some say the true number is worse, that major Western vaults don't even have physical inventory to cover their own liabilities. But that's not the only problem, because China didn't reveal the gap to panic the market. They revealed it to set up the next stage. Pricing power. Whoever controls the real inventory controls the future price, and China just told the world, without saying it directly, that they have more silver than anyone realized, and the West has far less. This is how superpowers shift markets without firing a shot. And tonight, as Asia opens, the early order books are already showing signs of distress. Bid-ask spreads widening. Spot markets disconnecting from futures. Physical premiums spiking in Singapore, Hong Kong, Shenzhen. Industrial buyers pre-booking months ahead, terrified they won't get allocation. This isn't volatility. This is the beginning of a structural repricing. Because if the numbers are wrong, and they are, then silver is in Singwar. Taoist T a 20 asset pretending to be stable. It's a $200 asset pretending to be suppressed. And once markets reprice based on actual supply, The adjustment will not be gentle. It will be violent, sudden, nonlinear. And the 83 billion at risk tonight, that's just the first wave, the shock wave. Because once futures start breaking, options break. Once options break, hedges break. Once hedges break, banks break. And China knows this. They didn't reveal the gap to explain. They revealed it to warn. The moment China revealed the 19-year silver gap, most analysts thought the danger was the number, the $83 billion exposure, the missing inventory, the imbalance. But the real danger isn't the gap itself, it's the timing. Because China could have released this information 10 years ago, 5 years ago, or even last year, when the world was still distracted by inflation and energy crises. But they waited until now. And there's only one reason for that: leverage. China knows exactly when the West is weak. They know when liquidity is thin. They know when banks are overstretched. They know when industrial demand is peaking. And they know when the US financial system is most vulnerable to a commodity shock. This moment right now is the weakest the West has been in decades. Because behind the scenes, several US banks are already showing signs of stress. Not from silver, not from gold, but from credit exposure, a commercial real estate collapse, and non-performing loans that have quietly doubled over the past 14 months. These banks are stretched thin. They're hedged to survive a bad quarter, but not a commodity shock, not a full-blown futures market dislocation, not a physical shortage that forces margin calls across the entire metals complex. And China knows this. That's why they revealed the 19-year gap now, to trigger the first wave of cracks. Inside commodity desks, phones are ringing nonstop. Traders aren't asking how this happened. They're asking who gets liquidated first. Because when $83 billion in exposure is suddenly repriced based on real supply, instead of the imaginary supply Western analysts assumed, it forces a domino effect that nobody can stop. The first domino is the ETFs. Most silver ETFs operate on a fractional reserve model. They don't hold the full amount of physical metal required to cover their shares. They rely on liquidity, not inventory. They rely on the illusion that you can always source silver when you need it. But now, with the 19-year gap exposed, that illusion is breaking. Slowly at first, then violently. Withdrawals have already begun. Allocated accounts are being drained. Industrial buyers are skipping exchanges and going directly to refiners. Sovereign funds are quietly placing off-market orders to avoid public panic. And every ounce removed from the system reveals another weakness. The second domino is the miners. Mining companies aren't prepared for this. Their hedges are priced on outdated supply assumptions. Their forward contracts were negotiated based on paper supply, not physical reality. And when the market realizes that global underground silver reserves were overestimated for 2 decades, miners suddenly become the choke point, not the solution. China knows this too. They understand that most Western mines are operating at break-even levels. They understand that capital expenditure is low. They understand that labor shortages and rising energy costs are crushing production. And they understand that once physical supply tightens, governments will start hoarding domestic output for national security reasons. That leads to the third domino, industrial collapse. This is the part analysts fear the most, not because industrial activity collapses immediately, but because companies realize they can't secure a future supply. When you're a solar manufacturer, an EV producer, a semiconductor giant, or a medical tech supplier, silver is not optional. It's essential. And once you realize that available supply isn't enough for global demand, you panic. And when industrial giants panic, they buy everything in sight. They overbook. They outbid competitors. They wipe out inventories. That S, how a hidden 19-year gap becomes a global scramble. Because once the world realizes silver was miscounted for almost 2 decades, every industry that needs it starts fighting for the same shrinking pool. And this is exactly why China revealed the gap now, because they're already locked in. They already secured their forward flows. They already built inventory buffers. Their industries won't feel the pain, but the West will. The fourth domino is the banks. This is where the real danger lies. U.S. banks are sitting on enormous silver derivative books, hedges, swaps, short positions, and options tied to a price that assumed supply stability. But now, with the real supply exposed, those contracts become time bombs. Because if the market reprices silver based on physical scarcity instead of paper abundance, every short becomes a liability. Every hedge becomes unbalanced. Every contract becomes a risk that grows by the hour. Banks don't fear price spikes. They fear volatility breaks. They fear dislocations where futures detach from physical. They fear arbitrage windows that become too big to control. And that's already happening. China wanted this. And here, S, why the timing is perfect for them. Industrial silver demand in China just hit an all-time high. Their renewable energy sector is exploding. Their defense manufacturing is scaling. Their semiconductor ambitions require massive silver input, and they secured all of it before revealing the 19-year gap. They didn't expose the gap to explain the past. They exposed it to control the future. Because now, every Western industry dependent on silver is waking up to a horrifying realization. China already cornered the real supply. And that leads to the final domino, geopolitical leverage. This gap gives China something they never had before. Not military leverage, not currency leverage, but industrial leverage. The ability to slow down or speed up the global supply chain simply by adjusting silver flows. The power to raise Western production costs without lifting a finger. The power to force industries to negotiate directly with China instead of global markets. And the US knows it. Behind closed doors, emergency meetings are happening. Commodity analysts are revising numbers. Treasury officials are calling banks. Defense departments are evaluating supply chain vulnerabilities. But nothing they do can fix a supply gap that took 19 years to create. This gap isn't an accident, it's a weapon. And the terrifying truth is this. The $83 billion at risk tonight is nothing compared to what comes next. Because once the market realizes the real scale of the silver shortage, prices won't rise, they'll snap. They'll jump levels. They'll skip ranges, they'll break charts. And in part 3, I'll show you exactly how this snap happens, what triggers the panic phase, and why the next move in silver wanted to be measured in dollars, but in shockwaves that ripple through every bank, every ETF, every industry, and every government tied to this metal. The moment the market finally understands the 19-year silver gap is real, not a rumor, not a chart error, not some misprint, everything enters what I call the snap phase. And the snap phase is completely different from a crash, a spike, or even a panic. It's the point where the market just stops behaving like a market. All the normal calculations break down. Traders can't price risk anymore. Algorithms shut down. And liquidity, the lifeblood of the market, disappears in a single minute. Think about it. You can price inflation. You can price a recession. You can even price wild currency swings. But what you cannot price is a 19-year mistake in the global supply of a critical metal. This is the exact point where everything begins to unravel. The first domino falls quietly. A major US bank pauses all new silver positions. This doesn't happen publicly, of course. There's no big press release. It's just a quick internal message that flashes across trading desks. Risk team requested temporary suspension of new exposure due to volatility modeling adjustments. That single sentence is enough to send a chill through the entire floor, because everyone knows what it really means. Their models just broke. And when one bank's model breaks, you can be sure the others are right behind it. This is the gap triggering a massive chain reaction. Silver futures start to widen. The bid-ask spreads, the difference between buying and selling prices, blow out to insane levels. Options pricing becomes completely distorted. Suddenly, the cost of volatility, the insurance against price swings, costs more than the metal itself. Market makers, the people who provide liquidity, pull their bids and offers. Exchanges respond by jacking up margin requirements. Retail brokers begin issuing urgent warnings to their clients. Then the freezes begin. Short, temporary at first, but just long enough to inject pure fear into everyone watching their screens. This is when the big US banks start to feel the real heat. Their massive silver short books, their bets that the price will go down, were all designed for a stable, predictable market. They were not designed for a 19-year inventory shock. Not for a cross-border imbalance of this magnitude, and definitely not for an $83 billion revaluation wave. Once the reality of physical scarcity outruns the fantasy of paper supply, the banks are left with only two terrible choices: cover their massive short exposure or get absolutely crushed by margin calls. Covering means they have to buy silver in a market where everyone else is also desperately trying to buy. Margin calls mean they have to pay billions upon billions in cash as the price accelerates far beyond what their models ever thought possible. Either option leads to catastrophic losses. There's simply no winning path for them. And you know who knows this? China. That's precisely why they chose to reveal this gap now, because in the snap phase, the side that holds the physical inventory wins. The side that holds paper promises loses. It's that simple. The next part of this story is where the public finally wakes up. Industrial buyers start announcing production delays. Semiconductor companies quietly revise their earnings guidance downward. Solar panel manufacturers start warning about material constraints. Car companies mention metal sourcing challenges. None of them use the words silver shortage, but the message is crystal clear. The world suddenly realizes that the supply chain isn't just cracking a year from now. It's cracking today, right now. And the panic spreads upward from industry to finance. Asset managers scramble to figure out their exposure. Pension funds start panic rebalancing their portfolios. ETF buyers, thinking they own silver, rush to pull their physical allocations from the vaults. The silver vaults in New York and London then experience more outflows in a single month than they normally see in an entire year. And then the snap finally hits the price. And the price doesn't move gradually. It doesn't tick up. It jumps. Huge overnight gaps appear on the charts. We start seeing price candles that nobody has seen in decades. The financial news analysts try to explain it, but they can't. The numbers don't make any sense. Because the prices aren't reacting to normal supply and demand anymore, it is reacting to the shocking discovery that most of the supply the market was counting on just wasn't real. US regulators start calling emergency meetings. Exchanges discuss temporary trading restrictions. The big banks start requesting emergency overnight funding windows from the Fed. Clearinghouses increase collateral requirements across the board, but none of it solves the core problem. You cannot regulate metal into existence. Meanwhile, where is China in all of this? They're sitting in a completely different position. Their refiners are fully stocked. Their key industrial buyers have priority supply lines. Their state inventory is untouched. They aren't scrambling. They aren't chasing the price. They're definitely not panicking. Why would they? They caused the snap, and now they are just sitting back and watching its devastating impact unfold across the globe. The US Treasury finally sees the real risk, not the price risk, the systemic risk. Because silver isn't just some shiny metal. It is embedded in literally everything the modern world uses. We're talking medical equipment, satellites, electric vehicles, solar panels, batteries, telecom hardware, defense technology, every microchip, and aerospace engineering. A shortage doesn't just raise costs for these industries, it halts production entirely. Defense contractors start asking very pointed questions. Manufacturers start requesting government inventory support. Hospitals begin reviewing their medical supply levels with a sense of dread. Slowly, painfully, the US realizes this isn't just a financial event. It is a full-blown industrial and national security threat. The snap phase exposes something much deeper. For decades, the West has been dangerously underestimating its dependency on physical silver. Now the banks enter the final phase, what they call liquidation mapping. They start frantically analyzing which of their positions will break first, which clients are most likely to fail, which hedge funds are over-leveraged to the point of collapse. It's pure damage control. But the damage is already done. When you have to unwind trillions of dollars in contracts that were built on a foundation of fictional supply, reality hits you like a freight train. The most shocking part is that even at this stage, the market still hasn't priced in the full impact. Because once industries realize the shortage is real and permanent, they will start hoarding silver for future production. That's when the real panic begins. That's the moment the price stops following chart patterns and starts following raw survival instincts. And that's when the hidden $83 billion gap becomes something much, much bigger. It's no longer just exposure or leverage or risk. It becomes a global revaluation of real physical metal versus empty paper promises. Silver stops behaving like a commodity. It becomes a strategic asset, a geopolitical tool, a national security resource. China understood this long before anyone else. That's why they timed the release of the 19-year data gap for the exact moment US banks were least prepared for it. They didn't need sanctions. They didn't need tariffs. They didn't need diplomatic pressure. They just used information. Information that detonated like an economic weapon. The snap phase ultimately ends with one unavoidable, brutal truth. The West must face a price level for silver that they never ever expected. Not because silver suddenly gained value, but because the world finally discovered just how much value was missing all along. The gap wasn't a mistake. It was a countdown. And the moment that countdown hit zero, everything changed. And now, the US financial system faces a reality it cannot escape. The very metal they thought they controlled is now controlling them. Thanks for watching. If you found this breakdown insightful, make sure to like this video and subscribe to the channel for more content like this. Stay informed and stay safe out there.